Young doctors, you're saving a bunch of money and you're investing. You know to be diversified, so you're buying a bunch of ETFs and mutual funds. But that could also be a problem if you don't know the types of funds you are buying. In the next 5 minutes, you'll learn why fees are so important when you're picking funds and why ultimately the cost savings of low-cost index funds will ultimately lead to the best choice to build wealth over time. I had a friend that bought different types of ETFs and mutual funds. It was a mixture of index funds and also actively managed funds. Now for the index funds, everyone kind of knows what index funds are. They are low-cost funds that follow the market. And you have so many types of low-cost index ETFs like VOO or SPY, and those funds follow the market called the S&P 500. Index funds are passive. You buy and hold them, and you don't really touch them until you really need that money. For actively managed funds, they're the opposite. They're actively managed. These funds are actively trying to beat the market by picking which stock will be the next winner, or by timing the market, trying to buy low before the market goes up and selling before the market goes down. This requires them to do extra analysis on which stock is going to be better or predicting when the market's going to go up and down. My opinion and the whole point of this video is that you shouldn't buy actively managed funds and you should just focus your time and energy on index funds. And I have proof on why I'm saying that. The long-term data shows that in the long run, actively managed funds don't really beat the market. So let me kind of show you what I mean. This is a chart from Morningstar, a well-known research company that does a lot of research on different types of ETFs and mutual funds. In this chart, you can see the percentage of actively managed funds that beat the market over time. But take a look at the 20-year numbers. Over time, you can see based on different types of markets, active managers just don't really beat the market, especially in the US. And you can see what we call the large cap blend, which is pretty much very similar to the S&P 500, where it's the top largest companies in the US. Not many managers can beat that. Only a handful of managers were able to beat the market over time. It also shows an interesting point here as well with the blue and red column. It shows that funds with lower costs are actually more likely to beat the market than funds with higher costs. And that's the biggest catch. It shows that the lower the fees, the more likelihood we will succeed in the long run. So why doesn't active management work? Well, many say that it's because the market or the current stock market is too efficient. What does that mean? Think of it as playing poker. You're not really going to be making much money if you and other people can use ChatGPT to find the optimal move. Everyone's just going to be too good. No one's going to come out as the victor with clear, better skill. In the US, almost every piece of information is available to you as the average investor and to the investment funds. And so there's not really an advantage that they're really getting there. Long gone are the Warren Buffett days where these funds are getting proprietary information from industry contacts or doing their own analysis. We can do it at home. Also, when we're paying for actively managed funds, we are usually paying higher fees. And those fees take a chunk out of your returns. So if there are managers that are underperforming, you also need to consider that you're paying extra fees to these funds. And so if you are paying a 1% fees to these funds, it might not seem a lot, but you're paying 1% every year, and that can add up to quite a bit. It's kind of like compounding, but compounding with fees. So it's definitely something you want to be careful of, and you can avoid it with index funds. And I'll give you the numbers right here. If you invest $5,000 a month into an investment fund that's earning 10% every year, and you do that for 20 years, you're going to get around 3.8 million at the end of 20 years. But what happens if you're paying for a 1% fee for that fund? And so let's say that return is now 9%. So if you're putting down $5,000 a month into a fund that's only earning 9% after fees, after 20 years, you are getting $3.4 million. So that's a $400,000 difference. And just because you picked a fund that was cheaper and less expenses, you're saving around $400,000. Definitely that saved money could be used for more spending, during retirement, or maybe it's for your kids' college expenses fully paid off. A lot of things you can do with $400,000. By the way, I'm working really hard to make good content for young doctors. So if you have time, go ahead and hit a like, subscribe, and also leave a comment below. And because the long-term data shows that most active managed funds don't beat the market in 20 years, it also shows that you shouldn't pick a fund just because it has had high returns over the past couple of years. There's always going to be winners every year, and if you're nitpicking these winners, it's likely not going to be a great strategy because these winners are not likely going to sustain those returns for the next 20 years, which is what we are looking at if we're investing for the long term. The data shows that it's incredibly difficult for an active manager to beat the market in 20 years. I'm not going to rely on myself to pick that fund that could potentially beat the market. The odds aren't in my favor. And if the actively managed fund isn't beating the market and you're paying higher fees and it's not justifying the fees, then why don't we just invest in the market through index funds? If you can't beat them, then join them, right? And with the index funds, you're keeping the fees, you're keeping the expenses as low as possible. There are so many index funds nowadays that are close to 0% expense ratio, which means you're paying close to $0 to these funds. And these fees keep on coming down year after year. You have super large companies like Vanguard and BlackRock that are well known that provide index funds for a lot of different types of markets. This is how I invest my personal funds, where I focus on number one, finding a fund that is low cost, and number two, finding a fund that is liquid as well. So liquid is also an important thing to consider, where if you are buying and selling a fund, you want to be able to find a buyer or a seller really quickly. So Vanguard is probably one of the most liquid index funds because there are so many buyers and sellers every day. On the flip side, there's obscure funds that are super low in fees, cheaper than Vanguard, but might not be as liquid. I think that, like a Vanguard fund that has around 0.03% is close to being free. And so I'm happy paying a little bit of money, a little bit more money to pay for that liquidity premium. One quick thing to note is when you're buying index funds, there's so many markets that you can choose from, and you might have seen US equities or international equities or large cap, small cap. That just means the different types of markets, US versus international countries. Large cap means large companies, small cap means small companies. And there's different types of markets because they don't really move the same way. If you buy a little bit of different types of markets, that actually helps you get diversified. But you really want to do more research on the different risk and return. Each different market might be riskier than others. Small companies are riskier than large companies. And so might not be best to put all your money in small companies. That's what you want to look at, and that's where you want to be diversified. And so here's my next steps for you. Number one, double check if your funds are actively managed or they are index funds. Number two, confirm how much fees you're paying to these funds. You want to specifically look at expense ratios and compare them with each of the funds that you have. And number three, if you are switching from an actively managed fund to an index fund, make sure you know what type of market you are getting into.